Hi guys, welcome to Side Hustle Investor. I am Abhishek Karki. I'm here today to talk about economic bubble and its different stages. I guess you guys have heard about different asset bubbles in news, so I'm here to point out what actually a bubble is and how it actually works. So an economic bubble or asset bubble is a situation in which the price of an asset is considerably higher than their intrinsic value. This happens when people are willing to pay more money for an asset without looking at their fundamentals value. So rapid increase in the price of an asset due to the change in the behavior of investor will cause the formation of bubbles. So at the end, when there are no more investors willing to pay the overinflated price, people panic and sell. So when people panic and sell, the bubble will burst. It will result in the price crash and people end up losing their money. Economic bubbles are not easy to spot and are often identified only after they are burst. In past centuries, we have seen and experienced many bubbles and its effect on the world economy. So let's talk about some of the famous economic bubbles. So the first one is the Dutch Tulip Bubble. In 1630s, the tulip bulbs prices in Netherlands went through the roof, reached its peak and crashed as soon as there were no more buyers. So the next one is the Japanese assets price bubble. In 1980s, prices of real estate and Japanese stock market went up rapidly. Speculative and overconfident investors started investing more and more money into real estate and stocks. In early 1990s, real estate and Japanese stock market crashed, leaving Japanese economy stagnating for years. So the next one is the dot-com bubble. In 1990s, due to the increased popularity of internet, share price of a lot of computer technologies companies climbed up. As the price was climbing up, more and more speculators entered the market, making Nasdaq Stock Exchange, which comprises of mostly technological companies, to reach its peaks. But in early 2000, panic selling started in the market, which resulted in the crash of the index by 80% and triggering US recession. So the next one is US housing bubble. After the crash of Nasdaq, a lot of investors left stock market and started investing into real estate, believing that the real estate is much more safer. So due to the increased number of investors in real estate, the US house prices nearly doubled from early 2000 to 2006. But at the end, due to the credit crisis, the bubble was burst, resulting into massive decline in the housing prices and leading US to the recession. Those were the famous assets bubble in history. Moving forward, let me point out some stages of bubble. First stage is displacement. Second is boom. Third is euphoria. Fourth is profit taking. And the fifth is panic. I'm going to explain all these stages taking the Dutch tulip bubble as an example. Before that, let me give you a bit more detail about tulip bubble. As I said earlier, the Dutch tulip bubble occurred in 1630s. In 1630s, Netherlands was experiencing surge in wealth because of the growing international trade. People were getting more wealthy and was able to afford more luxurious goods. Tulips started getting very popular in Netherlands and was considered luxurious goods. Some tulips were very unique in color and very rare to find due to which more people were interested towards it. Because of the limited supply and more demand of the tulip, the price of the tulip went up. At one point of time, some tulip even cost more than $10,000. Due to the less supply in the market, people started buying tulip futures. In 1637, the bubble burst when the tulip auction in Haarlem failed to attract new buyers. So panic started in the market and everybody started selling, resulting in a huge drop of tulip price in the market. So now let's move on to the stages of bubble. The first stage of bubble is displacement. In this first stage, a new technology or a new products come to the market and people get excited by it. In the case of Dutch Tulip Bubble, tulip was the new product in Netherlands and people were very interested towards it. Tulip has a distinctive and unique color. It was seasonal crop and very rare, so it gains a lot of popularity in Netherlands. Moving on to the next stage, boom. In this stage, price starts to get its momentum. As more and more buyers wants to join the party, the price increases. In tulip bubble case, tulip was a seasonal crop, and due to less supply of tulip in the market, there were more demand. Because of more demand in the market, the tulip price started to go up. Next stage is euphoria. In euphoria phase, caution is thrown to the wind as the price of an asset skyrocket. The early investors started to tell their friends, family about the investment and tell them to get into action. Here the greater fool theory applies. The idea that no matter how price go, there will be a market of buyers willing to pay more. Tulip price started getting higher and higher, costing them more than $10,000. But people were still interested towards it and started selling their house and property to buy the tulip futures. Moving on to the next stage, profit taking. In this phase, some wise investor will start realizing that the price of the product is reaching higher and higher than they expected. They start to doubt that the price is overvalued and not sustainable and start to sell their assets. In Tulip Bubble, when price of tulip was reaching more than $10,000, some few investors start realizing the unrealistic and unsustainable growth of the tulip. So they started selling the tulip future contract through auctions and made some profit. So the final stage where the bubble burst is panic. So in this stage, when people realize that everyone is selling the assets, then they start to get panic. Due to the panic selling, the asset price descended as rapidly as they had ascended. In 1637, when the tulip auction in Harlem failed to sell the tulip future to the new buyers, then the panic started in the market, resulting in huge decline in the price of the tulip. So those were the stages of bubbles. Financial bubbles will continue to form and grow and burst because they are driven by human behaviors. It is very difficult to predict a bubble, but however, becoming familiar with the steps involved in it can help you to spot the next one and helps you to avoid it. So that's it for today. Have a good day.